Well, good day, everyone, and welcome to today's launch of the Global Green Finance Index. And this is index number 7. Now, you'll probably know me. I'm Michael Mainelli. I'm one of the directors of ZN Group, and it really is a privilege today to have with me Dr. Andy Sloan, dialing in from Guernsey, one of the great advantages of these events. My colleague, Mike Wardle, who's director and head of our index group. Now, Mike, if you just wanted to move the slides along, the event that we're showing today is the launch of an index which began some years ago when we were looking at how could we evaluate moves to green finance. This was an analog of something that we had begun back in 2007, which is the Global Green Finance Index, and this Global Financial Centers Index, and this Global Green Finance Index runs in an extraordinarily similar way. And so today, what we'd like to talk through on our agenda is very much the idea of what are the results of the index at this time. Mike will be presenting for about 15 minutes. We also thought it'd be very good to have an indicative view of how people are reacting to it. And one of the people we've been really delighted to be working with has been Guernsey Green Finance. And Dr. Andy Sloan will be talking about unlocking private capital there. And then I'd like to make a few comments and observations about what this means, particularly in light of COP26. And then we'll turn over to you, the audience, for comments, questions, and answers. Now, I might point out, firstly, that yes, the slides will be available, although I would encourage you to go and read the full report, which contains a supplement, quite a lengthy supplement and detailed supplement from Guernsey on their thoughts on unlocking private capital. We will, of course, be putting the recording up in approximately 2 working days, so it should be up either late tomorrow or Monday. And finally, we do really want to have your comments, questions, and observations, but please type them into the GoToWebinar chat facility down there, because we're here online with you, and we will feed those comments, questions, and observations into the discussion. But with no further ado, if I may, I believe, Mike, the floor is yours.
Thank you very much, Michael, and welcome all to this event. As Michael said, I'm Mike Wardle, Director and Head of Indices for the ZN Group, and here to present the GGFI 7 results. So first of all, a bit about the index itself. We began the index, or first published the index in 2018, looking at the development of green financial centres across the world. The first edition of the GGFI included 47 centres. This latest edition includes 78 centres, and that's out of 124 centres overall that we look at when compiling the index. So the 78 centres now represented in the index are those which we judge have done sufficient in terms of developing their green finance offer to be part of the green finance world. The aims of the index are really to help track how financial centres are embedding green finance in their offering, and to highlight some of the best practice that we see across the world. A couple of definitions. First of all, what is a financial centre? We use the definition that was actually developed by UNEP, cities with an intense concentration of financial activity and an interlocking sense of financial sectors and transactions. And there is going to be a debate, I think, about how much a city is as important as a cluster or group of geographical areas as we go forward. Green finance refers to anything which is a financial instrument which leads to long-term sustainability change. And so that's what we mean by those two terms.
Mike, sorry to interrupt. I'm just not sure the slides are moving forward.
Thank you, Michael. I'll see if I can fix that. I do apologise for that. And the slides, if you want to go back and look, are up on the web page, and so do find them at some point. But to recap, just saying that the GGFI now covers 78 centres, as opposed to 47 when we published the first section of the index, and the definitions there are the ones that we use in looking at green finance. So the GGFI is a factor assessment index. This means that we use two different data sets to combine into the rating for the GGFI. The first set comes from a survey that we run continuously, which asks people in the financial services to rate financial centres in terms of the depth and quality of their green finance. The other set of data it says 100 plus, but it's now over 120 instrumental factors. These are quantitative measures, indices, and data sources, which we use and combine with the questionnaire results to give an overall rating for each financial centre. Looking at the range of people who get involved in the GGFI, first of all, respondents, you'll see from this that we have people from across the financial world take part in the survey, whether it's banking, insurance, the knowledge economy, policy, and public finance people, which gives us some assurance that we're capturing the views of a representative sample across the financial sector. And then the other part of this is the regional breakdown of people who respond to our survey. Asia Pacific, the largest sector, with Western Europe second, but a fair coverage in terms of people involved in green finance across the world. I mentioned the quantitative measures, the instrumental factors that are part of the index. And one of the things that we are able to analyze in the index is the correlation between those measures and the overall index results. And this table just gives you an indication, first of all, for all the instrumental factors, and then for the sustainability factors, those that are focused on green and sustainability, which are the measures which highest correlate with the overall index results. And the interesting thing here is that if I'm a financial centre thinking about how to improve my performance in green finance, these are some of the things I may need to look at in terms of where I perform in terms of these measures and how I might improve my performance, which are not just about financial measures, but are quite a lot general measures of the sustainability of an individual city or country, or indeed the quality of life that comes from being focused on sustainability and green matters. So the headlines for the GGFI 7 itself. First of all, Amsterdam took first place, narrowly beating Zurich, with London a close third. San Francisco and Los Angeles both rose a number of places in the index to enter the top 10. San Francisco to stay in the top 10, but Los Angeles to enter the top 10. Asia Pacific centres all consolidated gains, and they're starting to challenge incumbents from Western Europe. And one of the themes of the index results is that while Western Europe has really been the leader up in GGFI 1 to GGFI 6, the challenge from North America and Asia Pacific is strengthening. There is increased competition throughout the index. The margin separating centres at the top of the index is narrowing, but also the mid rankings in the index are very competitive. And as I mentioned, Asia Pacific and North America really charging ahead. And just as a note, we have up till now presented the Green Finance Index as two ratings, one of depth and one on quality. For GGFI 7, we've combined the scores to present an overall picture of centre performance. But in the full report, you can still find the depth and quality ratings that underlie the headline figures. So the top 10 centres I've mentioned, the big news here, I guess, is the gains for North American centres, for USA centres actually, San Francisco and Los Angeles. Western European centres in the top of the rankings have been relatively stable in terms of rankings, relatively stable in terms of the ratings. So we're seeing some consolidation at the top of the index as to the centres which are likely to remain leaders in the field. I mentioned that we also we still track the two dimensions of green finance depth and green finance quality, and this leads to slightly different rankings in terms of the index results. Amsterdam still comes first for green finance depth, as it does in the index overall, but Zurich takes first place in terms of quality, London second. So in terms of the quality of green finance that's taking place, we believe that Zurich and London are doing slightly better than Amsterdam. And so these things are, again, important when we look at how financial centres develop themselves. It means that if I look at the way in which centres divide between depth and quality, you can see here that London and Zurich are off the line in terms of quality. They have higher ratings for quality than they do for depth. Amsterdam is on the other side of that line and has higher ratings for depth than quality. So in Amsterdam, they may need to do some more work on the quality of green finance going on, maybe on their skills development. London and Zurich need to look at how they can make sure that more of the financial activity in their centre is green. The next analysis I want to share is the ranking by instrumental factor group. So I mentioned the 120 odd factors that we use to build the index. We run the index model several times to produce different rankings just using those factors which relate to sustainability, business, human capital, or infrastructure. And this does give a slightly different feel to the index rankings. So you'll see that on that measure, Amsterdam actually only takes top place in business, with London taking top place in human capital and infrastructure. This reinforces, I think, the fact that the ratings at the top of the index are very close, and it's only a few points change that would alter the ranking. And really the message from that is thinking about how a financial centre regards itself in terms of the range of the index ranking that it sits in, rather than necessarily focusing on the individual number. So being in the top 5 or the top 10 may be the goal, rather than necessarily to move up a ranking place or worry about moving down a ranking place. Leading centres over time have moved in the way you can see on the graph. And the key message, I think, for GGFI 7 is there's been a plateau. There's been steady improvement in the ratings of green finance over the years. That's now flattened off, and you will see that each of those centres is now either slightly dropping or has flattened off in terms of its performance. Within Western Europe, we've mentioned that European centres are pretty much leading the field. But just to say that beyond the top 10 of the index, Paris and Helsinki are very close. And again, Paris is only 2 points away from Stockholm. It's nearly in the top 10. So again, just looking at the index, we see that Western Europe continues to hold the lead place. In terms of Asia Pacific, there's been some big improvements. In fact, you'll see that the ratings for all of the centres in Asia Pacific in the top 10 have moved up. And in terms of changing rank, many of the centres in this region have moved up the rankings. So really putting pressure on other regions in terms of the top ranked Asia Pacific centres. Particular mention for Seoul, that's moved up 9 places, and Busan, that's entered the index for the first time in this edition. So Korea starting to show in the green finance rankings as well. Turning to North America, again, you'll see that almost all centres in North America have seen an improvement in their rating, and other than Vancouver. And there's also been improvements for most centres in terms of ranking. But the message here, I think, is that USA centres have started to challenge Canadian centres, and this may be a reflection of the new concentration on sustainability and climate change we see in the USA. Turning to Eastern Europe and Central Asia, the big news, I guess, is from Kazakhstan. Nur Sultan and Almaty have entered the index for the first time in GGFI 7. And in terms of this region, ranking at the top of the ratings, so they've overtaken Prague, that has been leading the GGFI ratings up till now. So again, and Kazakhstan, for example, issued its first green bond only last year, and is taking this very seriously in terms of the way that it organizes its finance through the Nur Sultan International Financial Center. In terms of Latin America and Caribbean, Sao Paulo continues to lead the rankings, and all the centres here have really improved their ratings. But you'll see that most of them have dropped in the rankings as they've been challenged by other centres, and this is really where the Asia Pacific centres have been overtaking and superseding some of the other areas of the world. In the Middle East and Africa, again, improvements in the ratings across the board, but Casablanca retaining its top spot. It's been top in the region since it entered the index. Dubai and Abu Dhabi have both improved their ranking considerably, as indeed has Doha, and Bahrain enters the index for the first time. So a strong performance there, I think, from individual centres in the Middle East, and Casablanca really holding its own in terms of the leading centre in the region. So what conclusions can we draw? First of all, that green finance continues to grow in popularity. Ratings of green finance rose in nearly all centres for both depth and quality of green finance. And so we can see that people are, but both in terms of survey responses, but also in terms of the quantitative data, there is improvement. Policy matters. The slide I showed about the instrumental factor groupings showed that the instrumental factors which lead the table in terms of correlation shows that cities where the whole city issue leadership on clean water, clean air, public transport, livability, where the culture is one of taking sustainability seriously, it's more likely that green finance will also improve and grow. Third, there's no room for complacency at the top. Western Europe is under pressure from Asia Pacific and North American centres, and that is likely to continue to be a trend as things like China's move towards a sustainable economy continues, but also across other parts of Asia and the USA. So that brings the headline presentation to the end. Do find the report itself online, and we'd be happy, as Michael said, to take questions and comments at the end of the session. But I'd now like to hand over to Andy Sloan, Chair of Guernsey Green Finance, to take over the presentation.
Thank you very much, Mike. Good morning to everybody. I'm just very pleased to say that we're great to be supporting and virtually hosting this launch of the ZN Green Index today. And thank you for giving me an opportunity to say a few words about the need to unlock private capital to support climate change mitigation. Obviously, that's a key factor to achieve the mobilisation agenda of COP26. Obviously in this year 2021 of COP26. Big issues really, mobilising capital and unlocking private capital. But first, what I want to do is just say a few words about Guernsey Green Finance. Actually, first, a couple of words about Guernsey. We're a specialist global finance centre, as the ZEM report flags up. We're a particular expertise and specialism in the servicing of private wealth and private funds and insurance. There's over $1 trillion of assets administered through the island. And we're proud to say we're a centre of real economic substance, well-regulated, tax transparent, and a strong and deserved reputation for meeting international standards. So, to slide one, Mike. Guernsey Green Finance, our sustainable finance initiative, established over 3 years ago. It's a public-private partnership, basically created and established to mobilise our skills as a finance centre to the cause of climate change mitigation. Our mission is to be at the forefront of the development of sustainable finance, and we do that through a programme of international engagement, product development, and training and capacity building programmes. We're very proud to be members of various different UN initiatives. Our commitment is from the highest levels of politics on the island down across the finance sector. We're a member of the United Nations Network for Greening the Financial System. I'm very proud to be a member of those too. We're also, the we're also members of the UN Finance Centres for Sustainability and the UN's Sustainable Insurance Forum. And our insurance sector is actually a signatory to the UN's Sustainable Insurance Principles. Our strategy is informed, obviously, by COP21 initially and TCFD, and that green finance is basically the cornerstone of our approach to sustainable finance, making a strategic commitment to be a leader in this field. And one of the benefits of our early strategic commitment as a jurisdiction is the early development on the island of skills and expertise in this space among firms and professionals. But we have established a comprehensive track record and an offer in this space, and over 75% of Guernsey registered funds are managed or administered by firms that are signatories to the UN Principles of Responsible Investment. But as well as the private wealth and funds narrative that I will be covering today this morning, we've developed momentum in many other areas too, particularly in terms of debt and insurance. The world's largest recycler of aluminium, Novalis, or Novelis, I should say, listed a 500 million note on the Tides Exchange just this month. Novelis is the leading producer of rolled aluminium products and the world's largest recycler of aluminium. We created the very first humanitarian catastrophe bond, covering pure volcanic eruption, using a Guernsey insurance-linked security, and that was sponsored by the Danish Red Cross. And again, that was just done and announced in just very recently in the last few weeks. So we're very proud of what we've been able to do, and meeting our objectives. And in that vein, we created the world's first regulated green fund regime, and I'll come to that shortly. But today, before I come to the green fund regime, I just want to go back to a little bit of history, and if we move on to slide 2 now, Mike, because it's easy to take for granted the position we're in today. That is, sorry, Mike, did you see to move the slide on? Yeah, magic. Oh, back one now. Sorry. It was a bit, sorry, it's a bit slow. My apologies. I should have remembered about the delay. But anyway, it's easy to take for granted the position we're in today with COP26 and the raising of the agenda and the advocacy of initiatives such as the ZN survey. But actually, if one allows oneself to take a step back in time, maybe just 2 years, it was not necessarily quite the case as it is today. And in fact, one thing that hasn't changed over that 2 years is that the fact that the scale of the problem is just still underestimated. We're not mobilizing capital anywhere near fast enough to meet the climate change, the net zero agenda. That we see a plethora of commitments and initiatives being made, but actually, if you look at the numbers, the underlying, the levels of investment, they're still not there, and it's a cumulative effect, and the need to invest is just getting greater and greater. The Climate Leadership Finance Initiative, the Bloomberg-inspired US initiative, estimated that 1.5 trillion of investment is required annually just in renewable generation, and that's ignoring transport, adaptation, and much else besides. And the current investment levels globally are not even half that, just to give you an idea of the scale of the catch-up that we need. And frankly, we talk about the COVID recovery and the greening and recovery, but there hasn't been a euro spent on the EU's green finance, the new Green Deal. This is all commitments to the future. So, and if we look at the UK's COP26 website, the donors, it says the donors must provide clarity on how we'll collectively meet and surpass the goal of mobilising $100 billion a year to invest for developing countries. And frankly, that commitment that was made at COP21 is still to be met. And so, meeting and exceeding that 100 billion target is essential. And we won't be doing enough to deliver the trillions needed unless we do more. And private finance isn't going to be a substitute for increasing public finance, but it is going to be vital in increasing the scale and reach of climate action that's needed. And again, what I'd like to do is return to the Climate Leadership Finance Initiative. And they recently published a report about unlocking private capital, and they have 4 policy areas. And we like to think that we've aligned our work alongside those policy areas serendipitously, fortuitously, but these are the 4 key aspects that the CLFI recently published. The first being to catalyse, it's important to catalyse new private climate finance at scale. It's important to improve the cost and speed of negotiations between parties on specific initiatives, i.e. we need to move faster, and we need to address areas where the market and sector-specific guidance is fragmented, and align with the current and global and national policy priorities to accelerate the transition. So those are the policy principles we're proud to, so that has guided our work in Guernsey already. And if I may move on, Mike, next to this next slide, which will be, again, I'll just take a look and wet my whistle a little bit there. Again, this is slightly historic research, but in terms of unlocking private capital in our area of expertise, you've got to understand the motivation of the owners of private capital. And so we historically undertook some research amongst family offices and private wealth, and I think this is about 25 billion worth of capital represented in our survey. And you need to get to the nub of understanding the motivations of the owners of private wealth to unlock that 30 trillion that's supposedly out there to be mobilized in support of climate change adaptation. And you come back to what is probably a traditional skepticism. It's all great. It's all very well and good as all getting excited and being on the sustainable and green finance jamboree and getting really excited that we're investing for global good. But one has to remember that at the end of the day, that people invest capital to safeguard its value and also to make a return. And it's frankly, at the moment, I do think that post-COVID, we've got a bit of an ESG bandwagon going on where everyone's applying a veneer of ESG and everything has to be ESG compliant. But one mustn't get away and ignore the marketing hype. And the narrative about generational shifts and about, the key, unlocking that and moving, more capital into this area still remains the need to have return and proven products. Unlocking the trillions, turning the billions into trillions, the research here that demonstrates moving from philanthropy of private wealth to sustainable investing, the key is to preserve and enhance the capital and generate return. And if you listen to our Guernsey Green Finance podcast, which I'm really proud of, it's a top 10 podcast, where I mainly speak to practitioners in the private sector. And you don't get away from this, is the fact that the need to generate return, the need to generate alpha is front and center at the center to unlocking private capital. And it's less a focus on rules, it's less a focus on regulations, and it's a concern with impact and return and the veracity of product. So finally, to a little bit of a taste of our work, what we've been doing in Guernsey, and next slide, Mike. Yeah, what we've been doing, like I said, aligned with those 4 priorities of climate leadership, finance and science initiative, I should say, is development of products, tools and guidance. And so this little taste of our work here, we're very proud that the Guernsey Green Fund regime, and it was the world's first investment regime or regulatory regime for investment funds. It provides a robust and transparent products for GPs and LPs alike. We're really proud of the testaments of support that we've had for this regime. Our rationale in doing this was to develop and provide confidence in the underlying greenness of the investment product, removing fears of greenwashing, which our own research when we were developing the product told us was a major concern holding back development of investment capital in this space. Our ambition was to make the fundraising process easier and to enhance the flow of capital to this area, and we've been very successful. Both the first and the most recent funds have cited the ability to raise finance predicated on a robust and transparent, and the veracity of the green investment product is a major benefit. So our ambition to make that fundraising process easier has worked. The regime itself is very straightforward and simple. We like to keep things simple in Guernsey. The fund rules are just 12 pages long, including annexes and schedules, and it's a notification and disclosure regime. It applies across any fund type. We have some of London's largest renewable infrastructure funds with part of the regime, and we have some very small private funds investing in forests, for example, and other things besides. But the robustness and confidence of the accreditation and verification process has been absolutely key to the success of that regime. Our research also told us that we needed to make the guidance simple, keep things simple and straightforward and easy for practitioners. And actually, the need to educate and provide and capacity build is an issue that crops up time and time again in the latest research. And part of the work we've done with the UN is understanding the skills shortages that exist within the sector. And it's the lack of expertise in this space that, frankly, we worry about, but it motivates the development of the tools and the guidance that we've been busily publishing over the course of the last few years. If you look to the specific tools that we've done to invest capital, we developed the world's first green private equity principles, which we published last year. Broadly speaking, an idiot's guide, a 101 for GPs and LPs. And every conversation and survey told us that the landscape was really confused about worthy but lengthy reports. In this sort of ESG era, what wasn't wanted was another several hundred-page long report that did nothing other than act as a paperweight, perhaps, or a doorstop. So 2 pillars, 8 principles, 20 pages. We created something we believe is an indispensable blueprint for the PE sector. Tim Hames, Director General of the BVCA from 2013 to 2019, recommended them, and he said they had the beauty of simplicity, I should say. So private wealth, and this in here, which is very much a specialism for Guernsey, and looking to unlock private capital to the agenda, is what I'm talking about today. This is a piece of guidance that we published late last year that's caught a lot of people's eyes. We produced a report to help family offices build sustainability into their offerings for clients, to allay concern about trustee duties and making sure that sustainable investments were capital. So we produced this guidance for sustainable trust deeds, as you can see there, sustainable investing for private wealth and family offices. And it clarifies that the inclusion of sustainable clauses within a trust deed can ensure that sustainable investing is consistent with the duty of the trustee. That is the basic fiduciary duty in common law parlance. So we ensured that it was consistent with the trustee's duty to preserve and enhance, so far as is reasonable, as the value of the trust of the property. So that's what we've been doing, and our commitment to sustainable finance means that we've been committed to the education of the private wealth sector in particular on the complexities and the specifics of how we funnel private capital and unlock it to mobilise the COP26 agenda. Like I said, in December we published this piece of research here, and shortly we'll also be publishing a new piece of research in the next couple of weeks looking at corporate governance in family office and private wealth practitioners, and actually giving an even more detailed report on how the whole structuring can work in the support of the sustainable finance agenda. So this is what we've been doing at Guernsey. We're delighted this morning to be virtually hosting the ZN Index publication. Ourselves, we've got a great track record of working with ZN, and we're really proud of the work that ZN have done in this field. And I'd just like to leave at my sort of section this morning by referring to the fact that we have very shortly our Sustainable Finance Week in Guernsey, which is the beginning of the 9th to 11th of June. We've got a range of great speakers. It's a hybrid report, obviously a hybrid conference. There'll be a physical event in Guernsey, but without necessarily the travel, without the open borders. But we've got Ben Caldicott from the UK Green Finance Institute. We have Sir Roger Gifford, Oliver Gregson from the MD of JP Morgan's Private Bank. We've got a host of leaders in the sustainable finance and private capital field joining us for Sustainable Finance Week in June, and I hope you'll be there to join us too. So thank you very much, Mike and Michael. That's hopefully time to be the 15 minutes for my short session on unlocking private capital.
Well, thank you very much, Andy. And you really are a bit of I'm not sure this is the best metaphor, but a pocket battleship of green off the coast of Britain. The number of initiatives, but also the impact that they've made has been extremely impressive. I'm coming back really just to talk about a few points. It's a lot to take in this morning, and I would encourage you, of course, to read the report, which contains much more detail. But let's have a little look at a couple of areas just before we move into the general discussion. The first thing I wanted to talk about is what is really on practitioners' minds, people who think that they're in green finance. What are they thinking about? And we, of course, ask them that. And we get back this spider web diagram showing their areas of interest. Now, in the past, this has been dominated very much by green bonds on the bottom right, almost pointedly, and a little bit on sustainable infrastructure and renewable energy investment. And those three areas are still quite strong. However, this spiderweb has broadened out over the last 7 editions. And in fact, in previous studies, it was very clear that green bonds almost dominated the area. So we are seeing some expansion in what people believe constitutes green finance and the areas and skills that they need to have. Of particular note here, though, might be to look at the weakness, effectively, of carbon disclosure and carbon markets on the top right. I personally believe this is going to change quite markedly. The carbon market experiment, which was what was bound into the Kyoto Agreement in 1997, came a bit of a cropper in 2007 when, under the European emissions trading system, the governments of Europe issued far too many permits, and the market did what a market should do: supply exceeded demand, and the price went close to zero. But that market has rebounded quite significantly over the last 2.5 years. We also saw on the 1st of April, the Chinese government put out a national ETS for China. And of course, we've had a new administration in the United States looking more seriously at getting a hardcore price for carbon and declaring what that ought to be, in its opinion, which was over $50 a ton. So there's been a significant move in this space, and I'm looking forward, perhaps in GGFI 8, to see some improvement in that space. The second area we wanted to look at on what's on practitioners' minds are the drivers of green finance. And so next slide, Mike. On the drivers of green finance, what we're looking at here is very much that the folks have been carefully checking out, if I can say that, carefully checking out a whole variety of drivers that might make things happen. Of course, what's been interesting about that is you'll notice here really 2 stand out amongst all the many things that there could be. It's very much the public interest in climate change and policy and regulatory frameworks. And I think this emphasizes a point that we frequently make. It would be ideal that there was no special thing in green finance, that we would treat green finance the same way we would treat shoelace manufacturing finance, that things were bound up into the cost base. This has been a particular topic of discussion, I will say, over the last 12 months here in London, at least, and that's whether or not ESG is really doing the job, or whether we should go back to the Kyoto COP and really make the carbon price work, which is certainly where the Chinese and the Americans are heading. So it's an interesting point here, but I think practitioners are beginning to question whether or not ESG is enough. Well, or perhaps is it enough, but is it really relevant in the time available? And there's been a number of discussions as well about the complexity of ESG, the alphabet soup of ESG taxonomies, and of course the moves, almost the taxonomic wars between the EU and Britain and other jurisdictions. So we're seeing the changes here on practitioners' minds as they're moving forward. I just turned to my third slide, which is to look at COP26 itself. I think it would be remiss of us here in the United Kingdom, with COP26 looming in Glasgow in November, not to just dwell upon this for a moment. So just to remind you, the 97 COP did result in the Kyoto Protocol. Then we had the Paris Agreement. But as Andy pointed out, the scale of investment just isn't really there. And COP26 offers us a unique opportunity to revisit the targets that were set and to submit new long-term goals for mitigation. This has been happening at some pace, not least the recent announcements in America last week, where Joe Biden had his climate summit. And so we're anticipating a lot of goals being announced between now and November. So hopefully COP26 will be able to finish the work that COP25 was unable to conclude. And we believe this could be an interesting first real test of the Biden presidency's stated aim of enhanced action on climate change. However, COP26 does raise a lot of high stakes questions. And for me, I leave you in the discussion area with a few things to ponder. I mean, first, we've been down this road before. Basically at Kyoto, it was in fact the idea of using carbon pricing and trading to control climate change was a US initiative, but then the US did not sign up to the Kyoto Protocol. President Obama was, of course, a major player in 2015 at the Paris COP, and again, America withdrew from the system. So a lot of eyes will be focused on whether or not the Biden administration is capable of enforcing through legislation some of the goals that it's signing up to internationally. But there's a lot of other things. COVID-19, impossible not to discuss on any webinar this past year, does question what path to take on the road to recovery. Are these actually bad times for big oil, or is it a good time to be burning carbon? A lot of countries are going to be probably more concerned with economic recovery first and worrying about the planet kicking the can down the road yet again. And we've been through these cycles before where green has been seen to be somewhat of a luxury. Very interesting to talk about when the economy is booming, but the minute that the economy has got any difficulties, it's pushed to one side. I do think as well, financial services, we talk about the tools and the innovation and green bonds, et cetera, but most of these tools have been around for a few thousand years, so I'm not too sure that it's about creating a new toolkit, although one of the things that we at CN and Long Finance have been interested in has been the idea of governments perhaps committing to policy performance bonds that would pay more interest if they failed to meet their targets. And the reason for that really is to address the point I made earlier, that the only special thing about green finance is the policy risk in it. The other question we have is a lot of the pushing and pulling of government and government interventionism could push private capital out. And this will differ country by country, clearly. But in a lot of European countries, announcements about government funds actually delay private investment because you want to wait until the fund is out, you see what the parameters are, et cetera. So you hold back on your current investment for fear that a competitor of yours might wait and get the government subsidy or co-funding or whatever. So government interventionism is not necessarily a good thing along private. In fact, the UNFCCC estimated something that 86% of the funding to eliminate climate change would have to come from the private sector, in which case I'd rather get that 86% out there and I can worry about the other 14% later. So will COP26 deliver? We've got a lot of other problems looming. Carbon has now become a bit of a stick in which to beat trade agreements. Will we see carbon border taxes or border adjustments, as they're often called, arising and really impeding trade and becoming a point of great detail? Or might countries be able to stick some broad principles? What do the fossil fuel reliant nations think of all of this, and how can they make their financial transition? The old stranded assets argument there. And eyes will certainly be on China and the US, well, and also, of course, on the EU. And all this will be taking place in a Britain recently departed from the EU, which is trying to establish its own ETS really from scratch. So there's a lot to play for, and if you like high drama and the high stakes involved, the next few months between May and November could be quite exciting for those of you who like to be political observers, or even better, political participants. So I'll turn back to the next slide. Just on the agenda, we've covered very much the basics of what we wanted to talk about today. And I'm going to hand back to Mike and ask Andy to join us for the questions, comments, observations, and maybe even some answers, who knows. Mike, over to you.
Thank you very much, Michael. Well, we have a number of questions, and of course, do keep them coming if things strike you. And first of all, I'm going to take a very technical question from Vanessa Chan, who just notes that the individual ratings for depth and quality have dropped considerably compared to GGFI 6, and it is indeed just a mathematical issue. We wanted to keep the main index on a scale of 1 to 1,000, but we had the choices of weighting depth and quality, but decided that we had no reason for doing that. So what we simply did was divide the depth and quality ratings by 2 and add them together to complete the index. So it's you will be able to calculate a consistent run of figures for depth and quality simply by taking the depth and quality measures that we've now published and multiplying them by 2, or taking the old ones and dividing by 2 to tie them up. So that's the kind of the technical question on how we've managed the change to a single rating. I'd like to move on to a question about cooperation between financial centres, and probably this one for you, Andy. And Bob McDowell has asked, do we see financial centres working together? And obviously it's the UN initiative, but could you give us a flavour of how that cooperation works?
Yeah, I mean, the best thing that we ever did was join the UN's Finance Centres for Sustainability. It's a group of 30+ centres now. I mean, it's basically it's a knowledge transfer and a sharing of expertise. And obviously with COVID, it's all been virtual for the last 18 months. But previous to that, there would be meetings and the groups would get together, and there wasn't ever a conversation or a meeting or a dialogue that we had that we didn't come away learning something and being able to sort of incorporate a specific sort of approach or a tactic, or just an innovation, and that sort of to seed or best practice and good ideas across different centres in a what I call a very effective and efficient manner has probably been the greatest, to me, is the greatest benefit of that grouping. It brings together like a unique sort of set of individuals who are straddling both public and private finance, and puts them in the room together, and the leaders have things to learn from the laggards, and the laggards have things to teach the leaders, and that that melting pot of ideas is broadly sort of, I'd say, the main way that the international collaboration works.
Yeah, I might add to that that there are just so many initiatives out there binding cities together. I mean, I'd add to that the C40 cities. I would add to that there's a non-fossil fuel non-proliferation treaty doing the rounds. So I don't think cities are short of reaching out, and they're reaching out at all sorts of levels. We're involved in a project across Northern Europe on green, which is an EU-funded project, but actually takes in UK cities such as Southend. So I don't believe it's a city issue. But one of the things I have noticed in the larger jurisdictions, of course, is that the cities are fighting some of the strictures and problems that they face, for example, on raising green funds and municipal bonds, or some of the strictures they face on regional transportation programs or regional energy programs. And in some ways, I believe the centralization, decentralization issues that we've been seeing around the world, whether they're Catalonia or Scotland or Brexit, or the Northeast, are raising their head here. Is this problem one that's going to be solved top down globally, nationally, or is it a problem that's going to be solved bottom up? The answer is, of course, it's going to be both. But I believe at the moment, the bottom up area is the one that's having the most difficulty getting going.
Thank you very much. There's a question from Maximilian Bierbaum about just noting that the major global financial centres, if you look at New York, Hong Kong, Singapore, it's only London that's in the top 10 in terms of the Global Green Finance Index. And this is something we've been tracking in the GGFI. If you go to the full report, you'll see some analysis of how the leading financial centres in the Global Financial Centres Index fare in the GGFI. And certainly, as Maximilian notes, this is potentially a competitive advantage for London, a position that we could reinforce in COP26. But I think the truth is that if you're looking at Hong Kong, Singapore in particular, they're putting a lot of effort now into green finance, both in regulatory terms and in developing their market. And so, as in all matters to do with financial centres, there is a great deal of competition, and I'd be surprised. I think London, in that case, just needs to keep working to be at the top of their game. And the other comment, I think, is it'll be interesting to track what happens to smaller specialist financial centres who've done well in green finance, whether it's Luxembourg in terms of the green bonds market, whether it is Amsterdam in terms of green lending, and whether actually the larger and more established financial centres, if they really turn their energy towards green finance, would start eating into the advantage that some smaller specialist centres have had. So we'll be again watching that quite carefully in future editions of the index. Moving on, if we could, Bob McDowell's also asked, how effective do we think tax hypothecation would be as a tool for public acceptance of green finance? And Michael, maybe you have a comment on that one.
Yes, I'm afraid I'm a bit of a skeptic on tax hypothecation, personally. I believe that there's a Godwin's law on the internet says that all internet discussions that get abrasive wind up with somebody accusing somebody else of being a Nazi, and I think there's something about all economic discussions that result in somebody creating a new tax. So it's a bit of a difficulty here. Tax hypothecation has really never worked in the long term, and this is a long term issue. So whether it's national insurance contributions or social security contributions or fuel taxes or road taxes, none of them, the piggy bank is always broken into because government funds are completely fungible. And once that happens, it's there. So tax hypothecation sounds good. People say something along the lines of, well, it's about 2% of GDP. So if we level a tax, then there you go, and problem is solved. But the reality is the governments see that pot of money, and a short-term issue like a crisis in schools or in the health sector means that they raid that piggy bank, and you can't stop them. Now, there's certain areas where I think hypothecation can work. Oddly, I'd say much more at the local level. We'll levy a tax to repair the village hall or something, and one can talk about it. But that too is in many ways a fundraising exercise as opposed to a real segregated tax area. So sorry to be a bit of a downer on tax hypothecation, but I'd almost put the shoe on the other foot, Bob. I know we've had these discussions, but please show me some cases where it's really worked over a longer period of time.
Thank you. And maybe a question, Andy, for you to start on, but I suspect Michael will have views as well. Christopher Gleedle asking, with policy and regulation standing out again as the main driver of green finance, does it suggest that decision makers still don't see that systemic green behaviour translates to increasing financial value? You were talked about the importance of alpha. Is there a sense in which decision makers in terms of private capital still don't see that link?
Well, it's interesting because I saw which is in the presentation, I saw that same point myself, that the regulation has been seen as quite a big driver. I think regulation has been a driver of the agenda. It's helped advocate, the fact that Mark Kearney then sort of brought climate change to everyone's consciousness by talking about systemic risk and making it a financial stability issue and the TCFD. And I think that really helped bring the whole issue to front and center. But at the end of the day, if you're looking at investing of private capital, you can't get away from the basic economics of it, is that people invest their capital to make a return. And so therefore you need the return and the alpha. It doesn't matter how much rules and the regulations there exist, that you have to take these factors into account. At the end, you can take any factor you want to into the account in your pursuit of return. And so therefore what's really important for the green finance agenda is to ensure that projects and the pipeline projects do actually generate the returns available. Now, and this is a conversation that Michael and I have had in the past, is that you're talking about, is there an alpha to the ESG agenda? And the research is a bit, one or the other. But I think if you are talking about stranded assets and risk and climate risk, and as soon as people start to price in that climate risk and discount that future to the present, the pricing of assets will change, and therefore the returns available to assets that are green and support the climate change adaptation or mitigation agenda, their price will rise and the returns will flow moreover. I think it's a fundamentally at the end of the day, you don't get away from the need to generate a return for private capital. There's no point in pretending it was otherwise. Michael.
I completely agree with you on that. It's without question that the idea of the long-term theme is what we're after here. And I think it's great that a lot of the initiatives that you've led on Guernsey have attracted the private equity, private investment community towards this. But they can't operate alone. And having been deep into the stranded assets debate, in fact, arguably we started it in long finance back in 2005. We had a project called Burn It All, which looked at what happens if you burn everything. Where is it? And then where's the value? And what are these huge transfers of balance sheet value in a downward direction? So that was the systemic risk bit. But I think the question that was being asked here is particularly good in the sense that where is it that we can get the assurance we need to make this a long-term trend? And I'm looking forward to COP26 in that regard, the tighter it can be, because people tend to forget we've been speaking about global starvation for 70, 80 years. And if you believe that the world was out to solve that, you would have been investing very heavily in developing countries for 70 or 80 years, and that hasn't really happened. So it's how do you get the belief that there's a genuine desire to solve the problem and a genuine desire to make it cost? And I still I keep batting a figure around, mostly to get people to come back, but they all hide away. I go, well, you know, the current ETS says that it's 40 euros a ton. The average Briton emits 8 tons, so that's 320 euros per Briton per year for 29 years to make net zero. By the way, that comes out almost identically with the numbers that the macroeconomists come out with, which is about 1 to 2% of GDP. If it was 2% of GDP, it'd be 80 euros a ton. And as you're aware, people are saying that 40 euros is a little bit too low. It should be more 80. The Americans have announced a number that's a bit north. So we're now talking, you know, 320, you know, to 640 a Briton per year. What politician has stood up and said that? And that's the sort of scale of cost that we need to start talking about. And then people invoke all sorts of ways to wriggle out of it. Oh, well, technology will save us. Well, that's great. And I've got some pixie dust too that I can add to the mix. So, you know, you're in this. From what we know today, those are the scale of the costs. Now they might decrease in the future. Maybe things that we can do. But if we don't want to talk about that scale of costs, then we're really fudging.
Thank you for that. We've got time for another couple, I guess. First of all, just Hugh is just asking the question about, you know, what might happen in terms of policy performance bond in the case of, you know, unforeseen events. In St Vincent, there was a volcanic eruption, which is going to make a huge difference to climate, you know, locally and so on. And I guess Michael's much more expert on this than I am. But I mean, first of all, you'd build some of that into. You think about the risk of natural disaster when you're trying to price a bond in the first place. But also for an investor, I mean, there's questions of hedging. I mean, how likely do you think it is that that government that issued a policy performance bond would actually meet its climate reduction targets? And if you think that's very likely, you don't need to hedge it. If it isn't, you might hedge it by investing in opposite directions. But Michael, any other comment on that?
Well, actually, I think you stated it well. But Andy, you know quite a bit about these volcano bonds, don't you?
Yeah, I mean, excuse me. Yeah, in terms of the development, I mentioned the volcano catastrophe bond that was launched in Guernsey and sponsored by the Danish Red Cross just a few weeks ago. In terms of looking at the parametric risk, it's a very useful way to bring in private capital to the adaptation agenda. So we believe that it's going to be because again, it's, you know, it's naked. It's based on the returns. So, you know, at the end of the day, the investors are looking at these particular products because of the increased risk and therefore the increased, you know, potential return, and using innovative, you know, insurance-linked security structures to draw in capital alongside these events is an efficient and an effective way to bring capital to the agenda in the developing world.
Final comment. So first of all, we've got just a participant who just asked me to pass on my thanks to Andy for his insights and comments. It was, you know, found it very interesting, the findings this time. And the final question, I guess, is, you know, the question: is it important in terms of trend that rankings continue to be tight and competitive, as green finance needs to be embedded regionally and nationally? And I think it is important. I think that element of both cooperation between financial centres, but also competition between them, is the thing that is going to continue to drive development in this area. As people, you know, see what other people are doing, go and talk to them to find out how to do it better, but then find another way to move that agenda further on. I think that's exactly the kind of development that the GGFI set out to track and to encourage. As with the UN Sustainable Finances Forum and other works being done between cities. So we've reached the end of time. Michael, would you like to finish off the session?
Well, merely to thank everybody, but I would say to those of you out there that last question that you ended on, Mike, is a very important one. GGFI is there to establish competition I always point out to people who don't like competition, would you watch an Olympics where people didn't care if they won? You know? So no, competition is important. It can get out of control as well, but appropriate competition here leads to sharing of thoughts and ideas. And I think we've got an interesting element of cooperation and competition. And for those of you who believe that London can be complacent, I assure you not. I'm anticipating huge rises in the Asian centers. China is very serious. Hong Kong is part of that. Singapore had a major announcement last year about its whole commitment to it. So they may have ignored this for a few years, but activity in Asia is huge at the moment. And I think I'd like to see every financial center be a green finance center, to the point that we don't need to talk about it. Thank you.
And so just finally, we look forward to the next edition of the Global Green Finance Centre, due in October this year. If you haven't taken part in the survey which underpins the Global Green Finance Index, please do. The reference is here on the screen, and the slides are available on the events page on our website if you want to pick that up. So it just remains for me to do a round of thanks, I guess. First of all, to you, the audience, for attending today and for your interest in the work of the Global Green Finance Index, ZN Long Finance. Very strong thanks to Andy Sloan. Normally we'd have a round of applause for you, of course, but we can't manage that on this occasion through, there are limitations to virtual technology. So you can have a very small round of applause. But you can imagine one. You can imagine it magnified several times. And thank you again to Michael for your contribution this morning, chairing and leading this work. So thank you. We'll see you again, and we look forward to that in the future. Bye-bye.
Thank you.
Thank you, Andy. Thank you, We Are Guernsey, too.